my screen. All right. Y'all can see my screen now?
Yep.
All right, cool, cool, cool. Volume okay?
Yep.
All right, perfect. It's off the way. All right, good evening, everybody. My name is Rob Cambrice. I'm the owner of Cambrice Tax Consulting. And tonight, I've been asked to present on tax planning for real estate investors. So I'll leave some time at the end for questions. So please kind of hold them to the end, and I'll be more than happy to answer your questions at the end of it. I will say this will be, I guess, like service level type of planning. Um, and I have a disclaimer in here that I'll get to in just a second. Let's see. Hopefully, let me turn my video off so I don't get delayed. All right. So a little bit about me. I'm a seasoned financing and investing professional in the tax industry. I've been in the tax industry for about 5 years. I like to say I'm a long-term tax professional because my dad is an accountant by trade, and I've been, around him all his life. He's had tax businesses and worked as CFOs for different companies. So he's kind of, put me in the on the path of learning about taxes at a younger age. So even though I only had my business up and running for 5 years, I've been around the tax industry for a long time. One of the reasons that I started my own tax firm is, I'm a serial entrepreneur. I've started many businesses before, and talking to other entrepreneurs and also, experiencing, being an entrepreneur myself. One of the things that I realized is that taxes is one of those areas that most people just aren't familiar with. They're afraid of it. They're scared of it, and they just don't know how to handle things in the areas of running a business, even investing in different assets and things of that nature. So I saw that there was a void in the marketplace for someone like myself to help small business owners and real estate investors get a better understanding of their tax situation and how they can limit their tax liability, when they're investing in their businesses and investing in different properties. Now, I want to give you guys a disclaimer. This is not personal tax advice for any one person on this call. I'm just going to, like I say, touch on some tax planning and some organizational things that we should be looking out for as real estate investors in the area of taxes. Now, if you have any individual or specific questions, I'm going to leave a link to schedule a consultation call with me, or just contact me if you have any specific questions about your individual situation. All right, so the items that we're going to talk about tonight are organizing your real estate business, some common deductions that you may be familiar with, um, real estate depreciation, as well as some tax planning strategies that you can implement in your real estate investing. All right, so first off, we're going to talk about organizing your business. Now, I like to start off with organizing, mainly because this is going to be like the bread and butter of your tax planning, of operating your real estate business or any business in general. So, first off, you want to make sure that you're organizing all of your documents, all of your financials, because when you do sit and start to do your planning, we just went through tax season, so you guys are probably familiar with this. When you get with your tax preparer, your tax professional, that's the first thing that they're going to ask you for is all of your tax documents. So you want to make sure you have those things organized and readily available so that those tax planning sessions can go a lot smoother. The next thing is choosing the right business structure. Then that can have significant tax implications. So some of your options include sole proprietorships, partnerships, LLCs, S corporations, and C corps. Again, I'll touch on each of these individually and talk about some of the pros and cons of each one. Also, you want to consider some factors such as so your liability protection, the flexibility of these structures, and the tax treatment when selecting a business entity or business structure. All right, so the first entity we're going to talk about is not necessarily an entity. But sole proprietorship is basically the simplest form of business structure. So a lot of people ask me, do I need a business structure? Do I need an LLC or something like that in order to, invest in real estate? And the short answer to that is no, you don't need it. You can invest in real estate and plan for your taxes without having a business entity in place. So that would be considered a sole proprietorship. And it's basically in the eyes of the IRS, they're looking at you as the business. You'll be the business owner. So everything is going to pass through your name and using your social security number. Again, it is a pass-through taxation, so all of the income and expenses, they will be reported on your personal tax return, which is your 1040, and you don't have to file a separate business entity for your tax planning when it comes to your real estate business in the sole proprietorship. Now, you do have some limited liability concerns. Since you are the owner, you're personally responsible for any debts and liabilities that you may incur while operating this business. All right, next we have the limited liability company, or LLC, which most people are familiar with. Now, the LLC, it does offer some limited protection for owners or members in the LLC. So basically, an LLC is a business structure or entity that separates you from any business transactions that you're operating in. So the IRS is going to see that you or your individual self is totally separate from anything that you do from a business perspective, and that's the purpose of the LLC. Now, the LLC doesn't give you any tax advantages, but it does offer some legal protections. Again, separating you from the business. Now, I can't really speak to the legal side of it. I'm not an attorney, but just to know, you don't get any tax advantages from setting up an LLC. It's mostly for like legal protections. Now, you do have some flexibility in the tax treatment under the LLC. Now, you can be taxed as a disregarded entity, which is basically a sole proprietorship, like we talked about on the last slide. You can elect to become, well, not elect, but you can be a partnership if you add more than two or more people to the LLC, or you can elect to become an S corporation or a C corporation. Now, just like the sole proprietorship, the LLC is a pass-through taxation by default, which means you don't have to file a separate business entity if you're a sole proprietor. All of that information is going to flow over to your personal tax return. Now, if you do set up, some of these other entities, then you will have to file a separate business entity, which we'll talk about in just a second. Now, partnerships. Again, if you have two or more individuals that are co-owning a real estate business or any business, then you're by default considered a partnership, and you would have to file a separate business entity with the IRS in addition to your personal tax return. Now, the partnership is also a pass-through taxation, which means that all of the income and losses that you incur in that partnership is going to flow over through to the partner's personal tax returns. So again, you still have to file a separate informational return for your partnership business, but you also have to file that information with your personal tax return during tax season. Now, if you break that down a little bit more, under the partnership, you can be set up as a general partnership or a limited partnership. Now, individual real estate investors, they don't normally elect to have these set up. This is more so for like syndications or funds where you have a lot of people that may be investing in a project, and you may have like 2 or 3 people that are actually running the project. That's when you'll start to get into the general partnership versus limited partners. And there's different levels of liability for those partners. Again, surface level information. If you're interested, of going a little bit deeper into that, we can definitely set up a call for that a little bit later. All right, the next is the S corporation, which is basically an LLC, but it's an election that you have to make with the IRS. There's a form you have to fill out to be classified as an S corporation, and it's pretty much a hybrid entity, and it basically combines the benefits of a corporation as well as a partnership. Now, this is also a pass-through taxation entity where all the income and losses flow through to the personal tax returns of the shareholders. And you also have to file a separate business entity with the IRS for your S corporation in addition to your personal tax return. Now, the shareholders do have some limited liability, and you do have some potential tax savings through reasonable salary distributions. So if you look at the difference between, an LLC partnership and an S corporation, the S corporation, you will have some tax incentives or tax benefits by electing that. But again, there are some nuances to becoming an S corporation. So before you just elect to become an S corporation, definitely speak with a tax professional and make sure that it is the right entity for you at the right time. All right. Let's see. Next, we have the C corporation, and this is a separate legal entity from the owners or the shareholders. So these are like big business entities. So like your WalMarts, Amazons. These are like C corporation type companies. I don't normally suggest a C corporation for real estate individuals. It's a lot of nuances to this. It can get pretty complicated, and you will run the risk of double taxation. So for a C corporation, you definitely have to file a business return and pay taxes on the business side. Now, if you do have dividends or you generate income in that C corporation and you pass that over to the shareholders, you'll have to pay taxes on the personal side as well. So in the C corporation, it's likely that you'll be paying double the tax amounts on the income that you're generating. Now, there are some potential for lower tax rates on the business income, but again, it's less favorable for real estate investors. So I've ran into a couple of real estate investors that were pretty new to investing, and they'll get into these programs where people will teach them how to flip properties or uh, you know get into funds and things of that nature, and they'll have third-party entities that'll set up these business structures for them. And starting off, they'll start them off with a C corporation, and it's just like it really doesn't make sense, and it'll actually cost you more money at the beginning to set up a C corporation if your business isn't set up to handle a large amount of transactions. It's just basically a waste of money at that time. All right, so next we'll talk about some common deductions. So I know we have a wide variety of people from beginners to more seasoned real estate investors. So you may be familiar with a lot of these. Some of them you may not be familiar with. So I'll go through them. So the first one is mortgage interest. So the mortgage interest is interest paid on mortgage loans for real estate investments, which is generally deductible. Is limited to the interest on the loans used to acquire, construct, or improve rental properties. And the deductions is subject to certain limitations based on the loan amount and the use of the proceeds. So again, I get new investors that come in and they give me their information and they want to deduct everything, and they don't realize that your mortgage is split into two halves. Is the interest portion and the principal portion. So as a deduction, you can only deduct the mortgage interest and not the principal. But the good thing about that is, most of y'all be familiar with how a mortgage works. You're more interest heavy on the front end of your loan, so you're actually deducting more at the beginning of the loan as opposed to when you're paying off the loan over time. So just be mindful of that if you're not familiar with it. You can't deduct your full mortgage payment, only the mortgage interest. So next, we have property taxes. So these are taxes paid on real estate holdings, which are generally deductible. And you can have these deductions included in your state, your local, or foreign governments. So there's some, depending on your jurisdiction or where you live, you can be taxed at the state level, you can be taxed at the local level. And if you have property in a country that's not the country that you live in, you can have taxes that you pay over there as well. So just be mindful of all of the taxes that you pay throughout the year on an annual basis, because they are tax deductible. Insurance. Last week we had a guy talk about insurance for real estate investors. So your premiums are tax deductible, and I hope everybody's using insurance to cover their properties. And those insurance coverages can include flood, theft, fire, any type of liability, and landlord insurance as well. All of those are tax deductible to cover your properties. The next we have is maintenance and repairs. So the maintenance and repairs are the costs incurred for ordinary repairs and maintenance, which are deductible. Now, some examples include plumbing repairs, HVAC servicing, and minor renovations. Now, one thing to remember about the maintenance and repairs is you want to make a distinction between what's an actual repair versus what's being improved in the property. So maintenance and repairs, those are tax deductible within the year that you make them. So again, if you have, an HVAC system that's broken and needs some new coils in it, and you're just servicing it and replacing those parts, that would be considered maintenance and repairs. You can deduct that expense within that tax year, as opposed to if you are replacing the whole HVAC system and you putting a new one in there, then that would be an improvement to the property, and you would have to capitalize that improvement and depreciate it over time. And we'll talk about depreciation in just a second. So just be mindful as you're going through the year and you're maintaining your properties. You want to have a good understanding of those items that you're taking care of, whether it's you're repairing something or you're adding to the value of the property and improving that property. And those items would need to be either deducted in that year or depreciated over time, just depending on what it is. So items like I said, replacing HVAC, roofs, replacing a new roof, those are some of the things that you want to consider as far as improvements. All right, so property management fees. I know a lot of us who are, scaling your business. Some people like to manage their properties. Me personally, I like to hand that over to someone else and let them run the property for me. So those fees are tax deductible. So any fees that you pay to your property management company, you can deduct that in the current year or the current tax year. And some of the services for property management may include tenant screening, rent collection, maintenance coordination, and eviction proceedings. So keep a tab of all of the money that you spend on your property management fees, because those are deductions that you can take for the year as well. I don't know if you guys are familiar with this, and you probably can't see it, so I'll go to another screen and make it a little bigger. But for real estate investors, on your personal tax return, if you don't have a business entity set up, you'll use this form Schedule E to report all of your real estate investments for the year. And here you're going to record your income that you generate for the property, as well as the expenses. So if you can see here where it says expenses, these are some more common expenses that the IRS expects you to deduct throughout the year. And this isn't an exhaustive list. There are other items that you can include, but just keep in mind, get familiar with this Schedule E and just go through these expense items, line 5 through 19, just to get a better idea of what items you can expense and deduct throughout the year, so that you can keep up with monitoring your profits and loss on each of the properties that you may have. All right, so next up, we're going to talk about depreciation. Depreciation can get a little bit complicated for some people, but depreciation is a big expense that you want to make sure that you're accounting for in your real estate investing. Now, depreciation allows investors to recover the cost of income producing properties over time. Now, the important thing about depreciation that I like to explain to my clients is it's a non-cash deduction. So basically, you don't have to put out any additional funds like you will with a repair in order to take this expense as a deduction. Once you place a property in service, then you can automatically take that in a depreciation deduction over time. Now, the depreciation reduces your taxable income, and it results in a lower tax liability. So let's see. So understand that depreciation is basically an accounting method for allocating the cost of tangible assets over their useful lives. So any asset that you place into your business, if it's eligible, can be depreciated. Now, for actual real estate, there's differences in how you depreciate the properties depending on what type they are. So for a residential residential rental property, it's typically depreciated over 27 and a half years. And then for commercial properties, the commercial property is depreciated over 39 years. Now, the difference between these two, residential real estate is any property that's 1 unit up to 4 units, or like a fourplex, and then 5 or more units will be considered commercial real estate. So that's the difference between those two, and they're depreciated over a different amount of time, different period of time, I should say. So here's a simple example of how depreciation works. So if you buy or purchase a rental property for $300,000, you have a land value of $50,000, and then the building value may be $250,000. Now, the thing to remember about depreciation is any land cannot be depreciated. Only the building that sits on the land can be depreciated. So make sure that you're separating out the value of the land before you account for your depreciation expense on your tax return. So annual depreciation expense of $250,000 divided by 27 and a half years, and then you get roughly a $9,000 deduction for your depreciation expense over the life of that building, or as long as you hold the property. Okay, so now we can get into a little bit of the tax planning. So tax planning is basically a series of strategies that you can use to proactively minimize your tax liability and maximize your after-tax returns. I know a lot of people were, up in arms when they heard about Donald Trump only paying $750 in, taxes, but a lot of that goes to, the team that he has around him and the tax planning strategies that they use in his real estate business. So a few of the strategies I'll talk about tonight are the timing of income and expenses, of course, depreciation, which we kind of touched on a little bit, and then a 1031 exchange. So the timing of income and expenses. So if you own a property for over a year, that would benefit from a long-term capital gains rate if you ever decide to sell the property. Any asset that you hold for longer than a year, you're subject to capital gains taxes if you have a profit, but those capital gains taxes are a lot lower, generally speaking, for most investors compared to a short-term capital gain, which is holding an asset less than a year and then selling it before that year is up. It's better to hold those for long-term if you want to take advantage of those long-term capital gains. The max that you'll pay on the long-term capital gains is about 20%. But if you're selling properties or selling any assets for less than a year, then you'll be taxed at your ordinary income tax rates, which can be taxed up to like 37%. So just consider some of the timing of your selling of your properties. If you're going to be selling your properties, if you're holding it more than a year, then you have an advantage on the capital gains taxes, assuming that you do have a profit on the sale of the asset. Now, depreciation. So there's a depreciation strategy that you can use, which is called the Section 179 depreciation, which allows business owners to immediately deduct the full cost of certain equipment or purchases within the current year instead of spreading them out over time. Now, we've lost the ability to take the full deduction. As of this year, we can only deduct up to 80% But there is a bill the House passed the bill, but it's waiting in Congress right now to be passed or denied, that it will allow this section 179 depreciation to go or to revert back to the 100%, where you can deduct the full amount of those assets within the current year instead of deducting them over time. Now, this is one of those strategies where it's important to, partner up with a tax professional throughout the year so you can learn, when these strategies are available to you so that you can take advantage of them. So like I said, right now, you can only deduct a portion of those assets that you put into service. But again, if Congress does pass it, we may revert back to being able to deduct 100% of those assets. All right, next one is cost segregation. Again, this is more so for investors that may be investing in bigger projects like apartment buildings, office buildings, things of that nature. If you have a large portfolio of residential properties, you can benefit from this as well. But if you have like one or two properties, it may not make sense for you to go through the cost segregation. Now, the cost segregation is basically a tactic where investors divide the cost of their property into shorter deductions, and this can lead to bigger tax savings. So basically, you can take an itemization of items that are inside of the property, so things like floors, fixtures, appliances, and you can itemize those things to take the deductions on those items individually, in addition to taking the depreciation cost or depreciation expense for the building itself. So cost segregation allows you to not only depreciate the building, but you can depreciate the items that you place in the building to help the real estate asset run. So again, things like appliances, fixtures, flooring, things of those natures can be added into a cost segregation study. Now, again, it makes more sense if you have a portfolio of a lot of properties or larger properties, because those cost segregation studies can get pretty pricey. So it may not make sense to do a cost segregation study if you have one or two properties. The cost to actually implement that strategy may cost you more than the tax savings you may get from it. So just be mindful of that with those cost segregations. All right, and the next one is 1031 exchange. So this allows you to defer gains if you sell a property. So if you sell one of your real estate assets, what the IRS allows you to do is, instead of paying taxes on the capital gains that you receive from the sale of that property, you can roll those funds over into another property of like kind exchange or better, and you won't have to pay any taxes on those capital gains. Now, you can continue to do this. As right now, there's no limit on the 1031 exchange, but there is a time limit on being able to do this. I believe it's like 90 days that you have from the time that you sell the property to the time that you invest in the newest property. Otherwise, you have to take those capital gains and pay the taxes on them. But this is a strategy that you can do over and over again, and you can continue to do it and hold those properties and defer those taxes up until you pass away. And you can pass those properties over to your heirs, and you'll never have to pay any capital gains capital gains taxes for any of those properties that you implemented this 1031 exchange strategy on. So that's the end of the presentation for me. Like I said, this was just a kind of a surface level topic on tax planning, organizing your business. But I definitely like to open up the room to questions that anyone may have at this time.
I'll go first. So when it comes to S-Corps, what's your idea as far as the amount of income, like net income, you should be bringing in? Because I hear different things from different accountants.
Right. So for me, I say anywhere between $40,000 to $50,000 in profit, that's after your expenses. Then it makes sense to elect to become a S corporation. Other than that, you know, the fees and the compliance pieces, it kind of outweighs the benefits of being an S corporation at that point. So my rule of thumb is about 40 to 50,000 in profit.
That's what I hear too. I hear anywhere from 40 to 50. So I'm just curious to see what you were gonna say. And then also I always hear people talk about like you should not own rental property or any type of assets in the S corp. S corp should be like for operation purposes only. What's your thoughts on that?
I agree with that 100%. It's a lot more complicated when you own actual, real, tangible assets inside of the S corp, just due to the tax policies that revolve around S corps. Um, my suggestion is always to hold your properties in an LLC, and then you can partner your LLC that holds those properties with an S corporation and do like a management style S corporation that takes control of all of the transactions, and then the LLCs just house or hold the actual assets.
Man, you about to go in the rabbit hole because now I got a follow-up question because I hear a lot of people talk about that, like having a management company that owns the LLCs. What would be
Yeah.
the benefit of that?
Well, so it separates the LLCs from the actual management company, and basically you would use the LLCs as kind of like, I guess, like shell companies in a sense. And then the S corporations are basically, you're using the S corporations for all the transactions and you get all the tax benefits from it. So, of course, with the S corporation, you have to pay yourself a reasonable salary. But the money that you don't pay yourself in a reasonable salary, any other profits that you have, those funds aren't going to be taxed on the self-employment side. So you get to save about 15.3% in taxes as opposed to running everything through an LLC where you're going to pay that 15.3% and self-employment taxes for those LLCs. So it's more of a tax benefit, and like I said, tax planning strategy to use the S corporation in that manner, as opposed to running everything through the through the properties. And then again, too, from a liability standpoint, things happen on properties. People can fall and twist an ankle, break a leg, or something like that. If you have all of your transactions running through the LLCs with the properties, then you're at risk of having those transactions being liable to payouts and things of that nature. So if you have your business operations separate from what's actually holding your assets, then you may be in a better position as far as being liable if something was to happen on your property.
Gotcha. Okay, and one last question from me, and then I'll open it up to everybody else. What would you consider a reasonable salary? What I hear is like 30%. Sometimes I heard 40, but for the most part, I always hear around 30.
Yeah, 30 is kind of like the standard, but it really depends on the industry that you're in. So you want to take a look at what's the standard for the industry. So for an accountant, his standard may be 100,000 as opposed to someone who's running some other type of business. It may be whatever 30% is for them, maybe 60,000. So it varies, but generally speaking, I wouldn't go no less than about 25 to 30% of your income that you generate. But again, it will vary based on the industry.
All right, bet. Appreciate it.
No problem.
Leslie had a question in the group. Let me find it real quick. She
Okay.
said, would furniture and decor count as expenses in a Schedule E?
So it wouldn't count as an expense. Well, let me take that back. It would be an expense under the depreciation. So you wouldn't be able to expense the full amount unless you do like a cost segregation or you do like a Section 179 deduction. So it will be included in your depreciation cost, because for furniture you have to depreciate those items over the life of that asset. So yes, it will be on the Schedule E, but it won't be a separate line item. It'll be included in the depreciation expense.
What up, Warren? Warren asks, can you be taxed as an S-Corp if you own multiple properties under one LLC?
Can you be taxed as an S-Corp if you own multiple properties under one LLC? I hope I'm understanding the question, but you have to elect to become an LLC. I'm sorry, elect to become an S corporation. So you would tell the IRS that you want to have this LLC taxed as an S corporation. I hope that answers your question. I'm not sure if I fully understood the question.
Yeah, that's what he's asking, but I don't get the benefit of why you would want to do that though, Warren. Mm. Like if you own multiple properties in one LLC, you can elect to be taxed as an S-Corp on that form. That is just one document you fill out for the IRS, but like the benefit of that, I don't know what the benefit of that would be to you.
Yeah, I agree as well. It looks like Jarrell had a question. Jarrell Jefferson.
Yes, how you doing? I got a question. So I know you was talking about depreciation and not depreciation, but I guess when maintenance of your property. So say if I decide to update put in a new hot water heater, would that be considered, would I depreciate that out, or would I just use that as an expense?
Hot water heater. So most of those are normally what, about $500, would you say?
Yeah.
Yeah. So any item that's $2,500 or less, the IRS gives you the option to elect what's called a safe harbor election. And you can expense that item in the year that you implement it into your property. So in the case of a hot water heater, you'll be able to take that as an expense, the full amount in the year that you put it into the asset.
Okay. But so say if anything costs more than 2,500, then I would depreciate it.
Yeah. You have to capitalize it and depreciate it over the life of that that asset.
Okay.
Mm-hmm. That was a good question.
And when you say over the life of the asset, you're referring to the rental property of 27.5 years, or just
the actual asset itself. So it will be separate. Yeah, it will be separate from the actual building. So the building is 27.5. But certain items, so like a roof, you can depreciate a roof for like over 15 years. So that would be different from the actual building itself. It just depends on the specific item that you're placing into service.
Okay, and is there anywhere where we could find how depreciation works on each item? Is there a place for it?
Yeah. So the IRS website, I don't know it offhand. I can Google it for you and
Yeah.
send it out. But if you just do a Google search for depreciable items and do :IRS, they'll pull up all the publications and they'll give you a list of the items you can depreciate and the lifespan of those items that they give you to depreciate.
Okay. Awesome.
Good question.
No problem. Thank you.
Michelle, you got a question?
Yeah, I have a question about the 1031 exchange.
Okay.
I understood it as once you first of all, the process, you have to identify that you want to do 1031 exchange, go to the intermediary, that part. So I got that. Then to the new property, you have to identify that within 45 days, but you have to close on it within 130 or 35 days from that date.
180.
I thought the funds had to be released by 180 days, but you had to. I think it says like 135 days, calendar days to purchase the replacement property, but the funds have to be released within the 180 days. I don't know. Either way, my question goes to, so that can cover a new building, right? Or does it have to be an existing property?
It has to be if it's when you say a new building versus an existing.
Yeah, correct. So if I put it, new construction. So if I identify, a lot and I want to go ahead and build and I can get it built within that time frame, would that still qualify?
That's a good question. To be honest, I'm not sure on that. I'll have to look it up. I know with the 1031 exchange, it has to be at least like kind or greater in value. So I'm not sure if a new construction, like building it from the ground up, will qualify into that. I just don't know that for sure. I'll have to look that up for you.
Okay. Thank you.
Yeah, no problem. Looks like, is it Rita? Rita had a question.
Yes, good evening, everyone. My question is, the amount that you're able to deduct for expenses, is there a cap on that based on income?
No. So you can have more expenses than the income that you generate. So for instance, if you generated $10,000 in rental income from a property, but you had $20,000 in expenses, then you'll basically just show a $10,000 loss on your Schedule E form. And depending on your overall tax situation individually, you may be able to use those losses to deduct against your ordinary income on your personal side. So to answer your question, is not really a cap, but being able to deduct those losses on your personal tax return, it would depend on your specific situation.
So the ability to deduct is what may have a cap on it based on your income. Say you have a W-2 as well, and you make over a certain amount of money. Is there a cap on the amount of deductions that you can have? I guess that was really the question.
Gotcha, I understand now. Yeah, so if you're not a real estate real estate professional, the IRS, it limits you up to 150,000. And if you're not a real estate professional, if your income is 150,000 or less, then you can deduct those losses from your rental properties. Up to $25,000, a negative, up to negative 25 in losses, I should say. But other than that, you have to be a real estate professional in order to unlock those losses. Did that help answer that question or clear it up?
Yes. So, and then with the real estate professional status, do you run the risk of being audited because you use that status? And if so, what are the I guess what is the information that you would need to provide to prove that you meet the requirements of hours for that status?
That's a very good question. So as far as the audit is concerned, nobody really knows what the IRS will do as far as an audit. It can be random, so we don't know for sure how or when they would audit. But there is guidelines. So for real estate professional status, you have to meet, I believe it's 750 hours per year operating as a real estate professional. And the IRS has a publication where they have a form where you can itemize, the transactions or the activities that you involve yourself in as far as real estate. And it's good to just keep a copy or keep a log of everything that you do and itemize your hours to show the IRS, this is what you've been doing for the year if they ever audit you. Now, a lot of people that try to, I guess, work around the system. But if you have a full-time W-2 job, it's kind of hard to prove to the IRS that you have a full-time W-2 job and you're meeting your minimum hours as a real estate professional. So just be mindful if you're planning on, trying to become a real estate professional and elect that status. If you have a W-2 job, that may raise a red flag and cause an audit with the IRS. But again, there's no guarantee that they will audit you, but it's kind of hard to prove that you work a full-time job and you're working, full-time as a real estate professional.
But what about if you have a W-2, but you work from home?
Still the same thing. If you're working from home and you're working for another company, I'm assuming if you full-time, you're working at least 40 hours a week, it's still kind of hard to prove to the IRS that you're doing that and you're a real estate professional at the same time. again, if you can pull it off, you know, and itemize and document everything that shows that you can do it, by all means, go for it. I'm not, you know, the end all be all of how those things play out in the IRS's eyes as far as if they're going to audit you or not. But again, from my experience, from what I've seen, this has been hard for people to have the W-2 and be a real estate professional.
Okay, thank you.
No problem. Just like Justin had a question. And I think Michelle, you have another question too?
Yes, good evening. Thank you for your presentation. I really appreciate it.
No problem.
My question is, I am about to sell my rental property, and I have been I fixed it up and everything like that. So I've been depreciating it for the last about year. And so I want to know, once I sell the property and I go to do my taxes next year, will I be able to depreciate everything at one time? Since it was technically, I guess, doing it, what, 27.5 years, which you get to depreciate every item? Like, how does that work as far as like on my taxes once I sell my investment property?
Okay, and how long did you say you had the property?
It'll probably be going on 2 years.
2 years, okay. And have you taken depreciation so far for the past 2 years?
Yes, I have.
Okay, all right, so you won't, so what happens is you don't take the full depreciation amount when you sell it. What actually happens is you have to what's called recapture that depreciation. So the depreciation that you did take, even though you got that expense, or you were able to deduct that expense for the past 2 years, when you sell the property, you have to add that depreciation expense back to the cost of the property before you sell it. So you don't get, you know, that additional depreciation for the life of the property. You actually have to add back that depreciation cost when you sell it.
So technically, would I only get like maybe 25 years instead of 27 type of thing, or is it, or is that?
No, you really just, you know, you get the deduction for the 2 years that you had the property, and that's basically it. So the year amount is just basically saying, you know, if you hold this property up to 27.5 years, then you can take that depreciation expense all the way up to 27.5 years. After 27.5 years, you're no longer able to take that depreciation amount.
Okay. Okay.
Did that help answer that question?
Yes, it did. I appreciate it. Thank you.
Yeah, no problem.
Hey, Rob, can I just jump in one more time? Sorry.
Yeah.
And then in your example, since you didn't pay taxes, well, you know, you were able to save whatever that depreciation expense was in the first 2 years. You didn't pay taxes on that money at all. So that's why you have to recapture, and that's why you pay taxes on that money when you sell it.
Got you. Okay. Okay. Okay.
So that's why he was saying the benefit of the 1031, if you owned it long enough and took them a lot of depreciation, you can roll that capital gain instead of paying taxes on it, roll it into the next property and keep kicking that can down the road and hopefully never pay taxes if you keep doing it long enough. That's what the wealthy do.
Okay. And since I technically had it over like what, a year and a day or something like that, I'm able to, will I still be able to roll it into a 1031?
You can. You probably don't have that kind of capital gain with just 2 years of ownership though.
No,
but,
no, I don't.
Yeah, so it probably won't be worth it.
Okay. And so what, can I ask one more follow-up with that one? So what type of capital gain would I need to make rolling it into a 1031 beneficial? Like how much?
Rob, that's your question. I mean, it would probably depend, right? You need to make sense of your financial situation. We don't know how much you pay in taxes each year. Like, it's a lot that goes into it.
Okay.
Yeah, I would agree with that. This is basically, you know, how much you're expecting to get in capital gains. Like I said, if it's minimal capital gains, then your capital gains tax may be small. You may not even have a capital gains tax depending on your overall income. So it's not a for sure answer to it. You basically have to sit down and look at the full scope of your tax situation in order to, you know, make that decision.
Okay, so more tax situation than actual like dollar amount.
Exactly.
Okay. All right. Thank you both.
Yeah, no problem. Michelle, you have another question?
Yeah, I was actually going to comment on the 1031 exchange, and I think people have to also understand when you roll it into a 1031 exchange, you're not getting any money. So if you were looking for some of your profits and trying to take back out your original investment, all of that gets rolled into the 1031. So you don't have access to that. Am I correct, or is that wrong?
Yeah, no, that's right. Everything rolls into it. That's how you can defer those the taxes on the gains. It was a good comment. Thank you. Any other questions? We have about 8 more minutes left.
Can you put your contact information in the note in the chat?
Yep, you beat me to it.
Right
I
on
was saying.
time.
Yep, so you guys can actually
Right on
scan
time.
Yep, you can scan the code. That'll send you to my calendar link. Or you can just, jot down my social media handles or my email address. I'm pretty flexible right now that tax season is over. So my calendar is wide open. Go ahead and hop on there for a free consultation if you need it.
Rob,
let me ask you, I'm sorry.
Oh,
Are you
no,
an accountant and a tax planner, or are you just a tax
that
planner?
was my question. Damn.
we in the same place.
Yeah, I'm not an accountant by trade. I'm a tax professional, tax preparer.
Okay.
Like I say, tax planner. Yeah, so mostly consulting, but I do the compliance piece where I file the tax returns and prepare the tax returns as well. I can do some accounting work like bookkeeping and things of that nature, but I'm not officially an accountant.
And you ain't telling where you from, man.
I'm from New Orleans originally, New Orleans, Louisiana, residing in Houston, Texas.
Yep. Dan, didn't you say you had some questions? Well, you must be away from the computer.
Mm-hmm.
Well, anybody else had anything else? Let me see. Make sure we caught everything in the chat real quick.
Look like Justin raised his hand again. Yeah, another question, Justin?
Yes, sir. One more. So is there, I guess, is the only way for you to, I guess, maybe get the tax benefits of owning an investment property is if you put it in an LLC? Like if it's just in your personal name, can you still claim some of the tax benefits?
Yeah, for sure. So, like I was saying earlier, you don't necessarily need any type of business entity to take advantage or operate like a real estate investing company. I should say, like rental properties and things of that nature. You can own it in your personal name, and you'll still just report it on that Schedule E that I showed you guys before, and let the IRS know, how much income you generated and all of your expenses for the year. So to answer your question, you don't necessarily have to have an LLC. The LLC is more of a legal structure to help you keep yourself separated from what you do in your rental real estate business.
Okay, perfect. Thank you.
Yeah, asset protection.
Asset protection, yeah.
Man, I was hoping we could have got a real estate attorney on here, man. I've been trying to find one that's knowledgeable that could add value, but haven't been successful in that. Let me ask you this, Rob. Do you okay, so with your clients that are real estate investors, do you ever meet with them along with their real estate attorney or their tax, not tax advisors, but the real estate attorney when y'all coming up with a game plan or a blueprint?
I haven't so far. Most of the clients that I've been working with, they haven't, used any real estate attorneys for their portfolio. So to answer your question, no, I haven't at this point. I'm definitely open to it. The closest I've worked to a real estate attorney was like an estate planning attorney. Someone that I know passed away and they had to do some, estate planning for the taxes. But I haven't worked with any actual real estate attorneys as of yet.
Okay, gotcha. And Ed asked the question.
Keep my ears to the ground for a real estate attorney that I could, refer to the group.
I bet. Ed asked the question in the chat. He said, as a business owner, is it unusual to pay taxes every quarter versus once a year? I heard this, but never followed up on the validity.
No, it's actually suggested, and not just by me, by the IRS. If you're expecting to owe more than $1,000 in taxes for the year, then you should be paying on a quarterly basis. Otherwise, you'll be taxed a failure, a penalty for not paying those estimated taxes on a quarterly basis. Now, I know a lot of business owners that I work with. I don't say a lot, but some of the newer ones that I work with, they just wait to the end of the year to pay, and they just pay the penalty as well. But you can avoid that penalty by paying those quarterly taxes. And again, it is, required by the IRS to do that.
Yep. And the penalty is usually what, a percentage?
Yeah, it's a percentage of what you owe. I don't know the exact percentage offhand, but depending on how much you owe, I mean, I've seen it as low as like, $60, and I've seen it as high as, like $2,000. So it just depends on, how much taxes you owe for the year.
Gotcha.
So that's the importance of planning, especially on a quarterly basis. You will know throughout the year where you stand as far as the amount of taxes that you owe in your tax liability, and you can kind of keep up with those tax payments throughout the year instead of waiting to the end of the year. And again, if you overpay, you can always get a refund. If you underpay, you just have to pay the balance of what you didn't cover throughout the year.
Great. All right. Aaliyah, you don't have no questions? Lord, you must be occupied over there.
No, I am battling food poisoning at the
Oh,
moment.
shit. My
I
bad.
can't support.
All right, my bad. Hope you feel better. Sorry about that.
No worries. Thank you.
No shots. I wasn't shooting no shots.
No, I always got something to give, so something gotta be up if I ain't talking.
Right. Dan, you back? Okay. Dan must have fell asleep. He's 6 hours ahead of us. Well, we appreciate you, my brother. If nobody have any questions, I just want to say thank you for coming on. If y'all have any specific topics, I don't know what's up next week, honestly, but if y'all have any specific topics y'all want to be covered, let us know. That's how we was able to bring the insurance guy last week. We got Rob today with tax professional. So if anybody have anything specific they want to know about, just let us know and we'll figure out a way to get it on. We appreciate y'all. Y'all have a good evening.
Appreciate you having me, everybody. Y'all have a good night.
Hey, Rob, post your stuff in the group, in the Telegram group.
Will do.
All right. Talk to y'all later.